Hi, this is Tim Biggam, and this is Vol 411 on one of the most interesting volatility days we have seen in a very long time. We're seeing the VIX at by far the lowest level since the COVID crisis began. Last I looked, around that 1815, 1820 level. If it holds here, that will be the lowest closing price on the VIX since, again, late last February. Interesting because we're seeing a fairly important jobs number being reported to market. Equity markets are closed, but yet we're racing to all-time highs on almost every major indice out there. So I think it all comes down to a too hot report may lead for that 10-year yield, which right now is about 1.7, actually down on the day with stocks up big, somewhat unusual. That 1.75 level seems to be the kind of a reflecting point for stocks here. On the volatility front, we're seeing contango really start to steepen in the curve here, as is usual when VIX heads lower. Everyone kind of stepping on short-term to finance or long-term. That's being reflected. I did a straddle comparative on the SPX. We're seeing last week's 5-day straddle trading at roughly about a 14 IV here, trading about 50 with the index, the SPX, at about 39.13. Today with the SPX around 4,000, that straddle has actually gotten cheaper, believe it or not. So we have the SPX higher, the straddle cheaper. Why? Because the implied vol on that straddle is now under 11. So that shows you how much that has cheapened over the course of a week. Notable trades yesterday and today. We're seeing some call buying coming in on the VIX, out of the money calls in the traditional Aprils, and we're seeing that put call ratio head under 0.5, about the lowest level it's been in a while. Perhaps the big institutions putting in some fairly cheap upside protection on the VIX, which means downside protection for stocks. So everyone out there, have a very good 3-day holiday, and we'll see what happens with that all-important jobs number tomorrow. Take care.